So, most people say, okay, it's not a great idea to save all of your money in the bank. Why is that? Because then we move on to the next topic, which is time value of money. So that's why we don't want to save our money. So if I ask you, would you rather have like $100 today or $100 in 1 year? Raise your hand if you agree with the first one. Okay, yeah, basically all of you, because this is like you understand the real concept, yeah? Because over time the value of money goes down. This is because of inflation. So over time, with some percentage, it goes down a little bit. So $100 today, maybe in 1 year, it could be 90 euros. So, okay, now if I ask you, would you rather have $100 today or 105 euros in 1 year? $100 today or 105 euros in 1 year? Raise your hand if you agree with the first one. Okay, now you guys are confused. This is like it's only 1% that said, okay, I will have the $100 today.
I'm not sure being alive in 1 year.
Okay, so now everyone is not sure. Okay, that's good, that's good. This is because we actually need mathematics in finance, yeah? We cannot just say, okay, like maybe this one makes sense. We need to calculate what will the value be in the future. So that's why we need present value and future value. These are basically calculating, for example, if we go with the present value, calculating what will 105 euros in 1 year will be in today's value. So that's when we use present value. Or you can calculate today's $100, how much will it be in 1 year? So you use future value. So the 100 euro, when you calculate it in 1 year, the value will be like this, or 105 euro in today's value will be like this. So that is the basic concept you should know, time value of money. So now we know this. Okay, it's not good to save your money, so we have to put in something that will give us a money back, yeah, or an interest. So we should invest in something. But do you know where to invest it? Or is it risky to invest only in one thing? So then we move on to portfolio. So this is a basket of investments. So only investing in one thing is not a great idea because it's risky. Yeah? One thing can go down, we can lose all of our money, or we can get a lot of money, but we don't want to take that risk. So we invest in a bunch of investments. These are like maybe stocks, which are buying a share of a company, like bonds, which is, actually Ahmed will talk about bonds more later on, but that means you basically loan your money to a company or the government, and then they will give you payment every period, and then at the end of the whole period, they will give you the whole money back. This is bonds, and then you can also invest in commodities like silver, gold. So these three things are the basic concepts you should know. So now you understand this, we can go deeper into finance and mathematics. And next up, Mohammed will talk about Atam, sorry.
Why is not there? No, that's why I said. Sorry, indeed. No, okay, I know what's happening. Yeah, it's the one, it's the old one. Yeah. Maybe not. Try? No, the other one. Get works, okay, get the
Alright, sorry everyone for the technical difficulties. But now we get started. So one of the most fundamental concepts in finance is actually the concept of arbitrage. And in very simple terms, you hear every finance guru say this, buy low, sell high. But it's a bit more complicated than that. And I'll actually explain to you what arbitrage is. Okay, so there are three key elements for arbitrage. It has to be the same asset. The transaction has to happen almost simultaneously. It means from the time you actually buy the asset and to the time you sell the asset, it should be a relatively little time frame. And what arbitrage essentially has is it's almost a risk-free profit. But don't worry, I'll explain a bit more. If this pointer starts working. It's working.
Maybe this is sensitive.
I'll give you a personal example. When I was here for my freshman year, I think most of you are in the Constructor University sales group chat, right? You can find a lot of different items, like a basket for sale or laundry basket or whatever. And what I found out people do is they actually just go to Kaufland, they buy it for like €5, and then they put it on the sales group for like 7 or 8 euros, because when you're a freshie and you're coming here, right, and you don't really know what the price of a basket is in Kaufland, you're more than okay to pay 8 euros for a laundry basket because you have to do laundry today. And very simply, that can actually be a form of arbitrage, because there was someone who took the opportunity of buying this laundry basket for cheaper from Kaufland or Action, and is selling it to a market in Constructor University where they're willing to pay 8 euros for that very same laundry basket. Or if you've heard the concept of dropshipping. Let's say, for example, you want to buy an iPhone. This iPhone today in the store costs $900. It's what most people are familiar with, that the price is $900. But you as an advanced researcher or as a business student or math student know that you can actually go to eBay and buy that same phone, an exact same phone, again remember it has to be the same asset, for $800. Now, you buy the phone for $800 and you sell it for $900, and that gives you a profit of $100. And it's relatively risk-free because you're buying the same asset that is already being sold for $900. And that's a very, very simple form of arbitrage. So, when we think about this, what arbitrage is, right? It's not just a profit-making machine. It's actually essential to financial markets in order for them to function properly. We always talk about how markets are self-correcting. If you've ever taken any economics class, you understand that one of the fundamentals of capitalism, the modern economy that we live today in Germany, is that the market corrects itself. And one of the ways it corrects itself is through arbitrage, because it ensures the law of one price. Ahmed will go into this in more details, understanding the math behind it, but essentially, all markets have to have the same price. If you have a free market in Germany and you have a free market in the US, the price of gold here has to be the same price of gold in the US. It's an essential pillar in order for our economy to function. And because there is information asymmetry, there will always be gaps in the market where, for example, the news of a war reached the US before it reached Germany, meaning that the price of gold ever so slightly rose in the US compared to Germany. There are traders out there that take advantage of this and exploit these tiny little loopholes at a very large scale, and that's essentially how they make profit from it. But the existence of these traders ensures that if there's, actually I think it's in the next one. Okay, it's not. Basically, the existence of these traders ensures that whenever a market isn't functioning uniformly with other markets, it gets penalized because it lost out on potential profit. I'll give another example. One of the most famous examples is actually with Forex trading. So imagine you have €1 today. That euro can be borrowed, or it could be a euro that you have. And there are different markets. So there's a market of exchanging euros into British pounds. There's a market of exchanging British pounds to US dollars. And there's a market of exchanging US dollars into euros. You start out with that euro. Today, the euro to British pound market says that one British pound is worth $1.10. So when you start out with, so a British pound says $1 pound is 1.1 euros, $1 is 0.8 British pounds, and 1 euro is $1.2. So you start out with €1. That €1 can be exchanged into $1.2. But remember, $1 is worth 0.8 British pounds. With that $1.2, when you actually do the math behind it, you end up with 0.96 British pounds. Those 0.96 British pounds can then be exchanged back into euros, leaving you with 1.056 euros. That basically gave you a profit of 5.6%, risk-free, because all you're doing is you're just exchanging different currencies for one another. The reason this could happen is because these markets, for example, the US is in a different time zone than Europe, and so news of something reached American traders before it reached European traders, and that always leaves those little gaps. And that is one of the most famous forms of arbitrage. So, in reality though, there are limits to arbitrage, because A, there are high transaction costs. When you're actually exchanging euros into US dollars, for example, you pay a transaction fee on that. So, as we said, you're only left with 5.6% profit. But imagine, for example, the fee of exchanging from euros into US dollars is 6%. That would mean that even if potentially there is profit, you pay transaction fees on those transactions, and that would not leave you with profit at the end of the day. There are capital constraints, because in order to actually realize profit, you'll have to place very large orders, which retail investors like us don't really have access to. And there's always information asymmetry. There will always be someone out there who has access to information before you do. And there are always firms out there that implement high-frequency trading, and they have access to a lot more computing power, a lot more time, and a lot more money than you do, and it basically leaves you in a worse position. I will now hand it off to Ahmed to explain the math further.
So the law of arbitrage, which taught a lot of classical finance, if you can put it that way. But as Adam mentioned, he said this a lot of times, the math behind it, So how does it actually work? And why is that true? To be able to describe it in math, let's make it a bit easy. Instead of talking about a continuous word, Let's say that we're talking about today, which is t is equal to 0, and tomorrow, which is t is equal to 1. Tomorrow, multiple things can happen. The markets can go up or anything can happen, you know. These are what we call mathematically states, which can also imagine as multiple scenarios. So I said, what it could be markets can go up, markets can go down, or markets can crash. And you, today, what do you have? You have assets. Yeah, sorry, and you're not limited to 3 states. You can also have multiple states, n states. And you, what you have today, you have assets. You can have assets 1, 2, 3, 4. And what you care about is what its price today. And if you buy it today, what's the payoff you get tomorrow? And again, you're not limited in the number of assets. You could have even m assets. So to recap, we basically have m assets and n states. And each asset has a price today and the payoff tomorrow. And usually, what do we use when we have 2 indices? How do we describe them? Vehicle object, a matrix. So let's define what we call the portfolio matrix, the payoff matrix, sorry. So the payoff matrix is defined as follows. It's an n by m matrix, so n states for m assets. The entry A of ij gives the payoff of asset j in set I. Then a portfolio is a vector in H in Rn. So basically how many units of each asset payoff of a portfolio isn't just A times H, and in which state? Set I. Because note that when you calculate A times H, so A again is your payoff matrix and H is your portfolio vector, you get a vector with n entries representing the payoff you would get in each of the n possible states. Then, using these foundations that we just defined, let's take an easy example to understand it more. Say that you have 4 assets today, 1 bond and 3 stocks. Say that, for example, your bond is risk-free. It's worth 1 today, and it's gonna be it's worth 1 in both states. If market goes up, it will be worth 1, and if market goes down, it will still be worth 1. While your stock will worth 2 if your market goes up, and will worth 0.5 if your market goes down. And it's saying since we have 1 bond and 3 stocks, we'll present them in the following vector: 1 bond, 3 stocks. Multiply your payoff matrix with your portfolio vector, and you get how much you would get if the market goes up, and how much you would get if the market goes down. Very easy example, right? So now, using these definitions that we just mentioned, let's define what's arbitrage. So, as I mentioned before, arbitrage is to get something for nothing, with certainty. It is not a good bet, neither a high expected return. It is, by definition, guaranteed profit with no risk and no upfront cost. So let's define this using our portfolio matrix, payoff matrix, and portfolio vector. So, we will say that a portfolio H is an arbitrage if and only if it costs less than 0 today, or equal to 0. So either you gain nothing, or you gain something. So either you pay nothing, or you gain something. If in every stage, it pays at least more than 0, or equal to 0. But it must pay strictly more than 0 in one state, at least. Or, if you know that it exactly costs strictly less than 0 today, so you gain money for sure. Then the day after, it just needs to pay more than 0. So, we can say that H is an arbitrage if and only if the scalar product of P and H is less than 0 and A times H is bigger than 0. What's P? P is a vector in Rn which represents today's prices. So if you multiply your payoff vector with its prices, and if it's less than 0, and tomorrow it pays more than 0, then by definition it's an arbitrage. So, there's one problem. As Adha mentioned, arbitrage shouldn't be possible, right? Because if it exists, then all of the market would go crazy, you know, and everyone would just search for arbitrage and make free money 24/24. That's why in finance, we have a very, very important axiom, which we call the no arbitrage assumption. Basically, no such H satisfying arbitrage condition exists. Now you may tell me,
And I'm just giving an example. And I was able to find an arbitrage. And you in your life, you must at least once bought something and then sold it for more. Of course. The axiom, it doesn't hold the non-existence at all. It's not equilibrium. Indeed. It is not something that we either agree on. As I said before, high-frequency traded firms exist almost entirely to find and exploit these arbitrage opportunities. Yet, as soon as arbitrage exists, everyone exploits it and until the price is adjusted back and disappears. The assumption just says that it is, and it gets completed so fast that for modeling purposes, it is almost negligible. So, I mentioned the iPhone examples, right? So, you're offered two choices. Either you buy a 300 euros iPhone or 500 euros iPhone. What would you do, Alex?
Well, I think if it's just only one condition, not taking others, of course we buy it. Like, I think this one, 300, right?
Indeed. That was the answer I was expecting, and that's the wrong answer.
Okay.
Because what the pro finance person would do, he would buy 300 euros and sell it for 500 euros and then gain 200 euros. That's the concern. The point is, if you have two objects, they should have the same price, you know, right? And that took a Nobel Prize. And that's what we call the theorem of the law of one price. It says that if two portfolios H and G have the identical payoffs in every state tomorrow, they must have the same price today. In other words, if A times H is equal to A times G, this should imply that P times H should be equal to P times G. Let's prove it. So, suppose that's not the case. Suppose that we have two payoffs that are equal, that are equal every state tomorrow, but today they have a different price. Without loss of generality, I can assume that one is more than the other because it's symmetric. You know, if I prove it with this one, I can switch it and so on and so forth. So we assume that P times H is more than P times G, which means that today's price of H is smaller than today's price of G. In that case, then the portfolio H minus G costs P times H minus G, which is more than 0, because P H is more than PG. Right? And tomorrow, the price will be equal to 0. Why? Because H times H minus G is equal to A times H minus H times G, which are equal and then it's equal to 0. And this cannot be possible. Why? By no arbitrage assumption. Because this would be basically an arbitrage, which then is a contradiction, which proves our theory. But the key thing is that the law for price is more than a theorem. It's a pricing machine. Let's say that you have financial contracts that you want to price, but you can't. It's pretty hard to price. It happens. What you would do then is you would build your own portfolio that replicates the payoff of this contract in every state tomorrow. Then, you will assume since they have the exact same price as tomorrow, they must have the same price today. And that's what we call derivative pricing. I'll read it later. But for now, I'll give the floor back to Adam.
Thank you, Ahmed. So, now we discussed arbitrage in detail, actually. But now we go on into another very important financial instrument, because if you are a company or you are a farmer or you are a student, you want to protect your exposure. The market is always going to be volatile, and you want to have some sort of insurance. You want to have some protection against that. And one of the ways to do that is through hedging and options, which offer you a part of risk management. So what actually is hedging? So hedging essentially is a strategy where you take an asset whose price will go up if the current underlying asset that you're trying to protect is going to go down. Think of it like financial insurance. You pay a cost up front, think of it like a premium. Same way you pay a premium for your health insurance. You are saying that, or a premium for your car insurance. You are saying you're going to pay a small cost right now, and next month, the month after that, so that if in the worst case scenario something happens to your car, you are protected. And that is hedging. But now it gets applied to the world of finance. And the most common form of hedging are actually derivatives, and in particular options. And let me explain what those are. So an option is a financial contract, and it gives the holder the right, but not the obligation, and this is the key word, this is why it's an option, to buy or sell an asset at a fixed price. That fixed price is called the strike price. And there are two main types. You might have heard of these jargons being used before if you've ever watched a finance movie, which is a call option or a put option. And basically, they are both forms of options, they are forms of hedging. A call option gives you the right to buy an asset at a strike price, and a put option gives you the right to sell an asset at a strike price. And what makes it very desirable is because there's little downside or a very big upside of protecting your asset or protecting your car in our example, because you're paying 100 euros a month to protect a car that is worth 20,000 euros. So let's give an example with a put option. Let's say today I have a stock. Let's call that stock Constructor University stock. And that stock price is currently $100. So I buy a put option on Constructor University, and it says that I can sell this this stock, Constructor University stock, in the future at the price of $100. Now, if the price falls, let's say the university changes presidents and people are no longer satisfied with the university, hypothetical case, and the stock price falls, and it falls to $70. Well, if I had just bought the stock itself, now I would be down $30, because if I sell it in the market, I would lose $30. But in this case, I don't lose anything because I have a derivative. It's derived off the main price of that instrument, of that stock. And now I can still sell the stock for $100. So I didn't actually lose anything. I've been protected against this price fall because I held a put option on the stock. And when you buy the stock, so at the start when I actually buy the stock, why would someone sell it to me for $100 if the current price is $100? Well, because you charge me a premium on it. Basically, someone is willing to give me the right to sell him this stock for $100 as long as I pay a premium on it. Always remember the simplest, the simplest example could be insurance. You pay a premium to an insurance company so that you can essentially sell that car back to them when that car is totaled at the same price. Ahmed is actually going to go more into those details, and what advanced firms use is something called Black-Scholes, and he will explain it more. But for now, think of it as there is an intrinsic value. So if the price goes down to $70 and right now it's at $100, there is a $30 difference. That's an intrinsic value of the put option, plus a little bit more on top of that to incentivize it. So this put would probably be worth around $35. And the more the stock price falls down, the higher the put option actually becomes, the more value it gains. Because we can see that when the stock price is actually at $100, right now you're only paying for a premium. Because you can still sell the stock for $100, so you're not really better off getting a put option. But say you want to protect yourself, and you buy the put option for $100 and you pay a premium on it. Now, when the stock price goes down to $80, the put option has an intrinsic value of $20. So you lost $20 on the stock you had, but you also hedged it by buying a put option. And so the $20 you lost on the stock is equal to the $20 you gained on the put option you had, because now that put option is worth $20. Do you guys understand this concept? Yes, Tom?
What happens if the stock price increases rather than decreases?
Exactly. If the stock price increases, it's an option. So you just don't do anything. You still gained value on the stock, because now Constructor University stock is $120, you made profit, and the only thing you lost is the premium you paid on the put option, which could be like $3 or $5. It's almost negative. So you still make profit if the stock goes up, and if the stock goes down, you minimize your losses. Is that concept clear? And so put options are one of the best forms of hedging. Yes, Nathan.
So, like, do you usually, when you buy a put option, do you buy the same value of the stock, or do you buy like whichever amount you want?
So if I understand your question correctly, is if you buy a put option of the same stock.
Yeah.
Yeah, so if you currently own Constructor University stock,
Yeah.
you would buy a derivative of that stock. So you'd buy a put option for Constructor University stock. And when Constructor University stock increases, you're happy, you're invested. It goes down, you're still protected.
Okay, so like the value you buy is the same amount as the stock you buy.
It's a derivative of it. So if the price of the stock goes up,
Yeah.
the derivative price would go down essentially. Or if the price of the stock goes down, the derivative price of that stock would go up. Okay. So again, I told you basically a put option and call option are the same, except you can, one gives you the right to sell and one gives you the right to buy. So if you can also apply the same thing if the price increases. Say you're a farmer, for example, or no, say you're a company that wants to buy farm products. Say you're Heinz, for example, and you want to buy ketchup, but you also want to protect yourself against the price of tomatoes going up. What you can do is you can buy a call option on tomatoes, so that even if the price goes up of tomatoes, you can still buy tomatoes at the same price that you're used to, only paying the premium. Is that concept clear? Whether the price goes up or whether the price goes down, you can buy financial derivative instruments to protect you against any price fluctuations. Yes, Tom?
Who covers for that? If for example, because obviously you benefit only if, for example, the price goes down, so you're protected.
Yeah.
Let's say it goes down a lot. What is the outside?
So you mean who's selling you this put option? So that could be like an investment bank. So Deutsche Bank, for example, has a whole department where they sell these options. So you go to Deutsche Bank and say, Deutsche Bank, I don't like the fact that I'm not protected with my Constructor University stock. Can you please sell me a put option on it? And they'll be like, yes, we would love to sell you a put option, but if you want to buy a put option, you have to pay a premium on it. So you pay 10 euros every month, and we will give you a put option for the stock. So the only reason Deutsche Bank would do that is because they want to collect these premiums, right? It's the same as an insurance company. Why does TK insure you? Health insurance, health operations are very expensive. You have to pay doctors and machines. It's very expensive. But there's still an insurance company out there willing to insure you because they'll collect premiums based off of that. But hedging actually goes beyond options. Yossi earlier mentioned that you can have a portfolio. And essentially what a portfolio is don't put all of your eggs in one basket. You don't have to get a call option or put option. What you can simply do is just buy different assets. You could, for example, invest in a tech company like NVIDIA, and you can also invest in McDonald's, because if the economy is doing crazy well and everyone is investing in AI, the price of NVIDIA is going to go up. McDonald's is probably not going to be affected. But say people are no longer interested in AI, they still want to, people are still going to go to McDonald's every day. So whatever happens in the economy, you're always protected because not all of your eggs are in one basket. You're investing in different industries. And that is a form of hedging. And it's not a single tool, it's a whole mindset. You basically think, what could go wrong with my investments? What could go wrong with what I have? And how do I protect it? Warren Buffett, one of the most famous investors actually, is one of the largest investors in Waste Management, which is a trash collection company in the US. You'd think Warren Buffett has hundreds of billions of dollars to invest. Why is he investing in waste management? And when he actually explained this, he was that even in a recession, people are still going to throw away trash. So even in the worst case scenario, even if there is a recession, the whole world is on fire, people are still going to throw away trash. So waste management, the company, is still going to be there, and they're still going to protect revenue. And that's one form that Warren Buffett used for hedging. And if Warren Buffett is okay with investing in a trash company, so should you as a retail investor, because you're protecting yourself. And now I'll give it off to Ahmed again for the next point.
So we've been talking about options for a while. And options are pretty good, I'm being very serious, options are really good. It's a bet that you can't lose. So let's say I want to buy an option. What's the fair price of a bet you can't lose? Because, of course, they won't say it for free, So there must be a way to quantify this, a way to be sure, okay, this option is worth this because, of What's our expectations? Do you remember what I said before? I mentioned before the low point price. And I mentioned something that is called derivative pricing. And I told you that we needed it. And that's what we needed. We will use derivative pricing in order to price our options, in order to price this bet that no one can lose. So, the first step would be, what's the payoff of our option, right? So for the sake of the example, we will try to price a European call option. Recall that call option means that we have the right to buy our stock with a strike price until the end. Not before, but until the end of until the expiration date, basically. So, you have a stock today, S, with the price S, and the K is the strike price. The price that you are given, that you can buy S with the K tomorrow. As we said before, tomorrow has multiple states. Tomorrow, the stock can go up, or can go down, right? Which we call SU and SD for the sake of the notation. But what's your payoff tomorrow? As we said before, tomorrow you have the right to exercise or not exercise your option. As we said, in a call option, you have the right to buy or not buy your stock for price K. So the price is basically the maximum between the difference of S minus K and 0. Which means, let's say that tomorrow the stock was worth more than K. So of course we would buy it because we would buy it for less price K, right? So SU minus K would be more than 0. And then the payoff would be SU minus K. And if it went down, let's say it was less than K, you won't buy a stock for a higher price, right? So you would get a negative value, and then you would go with 0, because you won't exercise your option, and then you gain nothing. So we say that in general, that the payoff of your option tomorrow is maximum of SU minus K 0, or SD minus K 0. So, as I said, let's take an example for understanding. Let's say that today you're given a call option with the stock that is worth 300 euros, and strike price will be 250 euros. Tomorrow, let's assume that the stock goes up to 320 euros. In that case, your payoff would be 70 euros. Why? Because it's the maximum between 320 minus 150, which is equal to 700 euros. And of course, 700 euros is bigger than 0. So we'd go with 700 of payoff. Why? It can go down to 240 euros. 240 euros minus 250 euros is equal to minus 10 euros. Will you buy a stock that's worth 250 euros for 250 euros? Of course not. So you won't exercise your option, and you will go with nothing. For notation purposes again, we call the payoff when the stock goes up CU, and the payoff when the stock goes down CD. So the next step would be then that, given again this S, SU and SD, we want to find a new portfolio that will have the exact same prices as our option tomorrow, is CU and CD. And by law of one price, we would conclude that the price of our option would be equal to the price of our portfolio today. A very common portfolio that's used for as a replicated portfolio is a number A of stocks and the number B of bonds. And the question is, how many stocks do you need to buy and how many bonds do you need to buy so that tomorrow their price is exactly equal to CU and CD depending on which stage will you land in. And for the sake of the ease of the example, let's assume again that our bond is risk-free, that it is worth 1 in any possible stage. So then we would remove B and just leave AS plus B, since big B is equal to 1. So, what we need to do is to find A times SU plus B is equal to CU, and when A is equal to SD plus B is equal to CD. Recall that AS plus B is our portfolio. And tomorrow, if the stock goes up, the stock will be worth SU. And we want its price to be worth, its payoff to be worth CU. While if the stock goes down, its price will be worth SD, and we want its payoff to be equal to CD. We have SU, we have CU. That's basically a system of linear equations. Easily solvable, right? So you would solve the system of linear equations and find AB, right? Very easy, 90% could solve it. Then, by definition, the price of your portfolio today, just A, times S, the initial price of the stock, plus B. Done. And then, by the law of firm price, we know that the price of our portfolio is equal to the price of our option, which is then is again equal to AS plus B. So, notice that the formula do not depend at all on probability of the market going up or down, right? But we don't care about this for now. What we have done until now is only purely simple mathematical algebra, right? We just found AB such that our portfolio was equal to our portfolio's price was equal to the options price. However, if you do some algebraic manipulations, we found that we can write A and B as this very big formula, CU minus CD over SU minus SD, and B is equal to this. You would get this thing when you solve this type of equations. Just give it for speed. And then we find that C is equal to Q times CU plus Y minus Q times CD. Again, I'm skipping how we find it, but I'll start straightforward algebraic manipulations until we get in this form. And where Q is equal to Y minus D over U minus D. Do you notice something? Notice that Q is in 0, 1. Since D is more than 1, it's more than U. And Q plus Y minus Q is equal to 1, of course. Q's behavior is close to being a probability. But the definition probabilities are always between 0 and 1. And the probability plus the negative event is equal to 1. Right? Q is actually what we call the risk neutral probability. Why? You will see now. Because when you look at this formula, C is equal to QCU plus 1 minus Q times CD, it is close to just look at maybe the expected value of the payoff tomorrow. Where Q the probability of going up, and 1 minus Q the probability of going down. And we call Q the risk neutral probability because under Q, the expected payoff tomorrow is equal to Q times SU plus 1 minus Q times SD, which is equal to S itself. So when the probability of going up is Q and the probability of going down is 1 minus Q, the expected payoff tomorrow is the exact same as the stock today. And why is this even Q useful? Okay, I looked at this Q and we have Q and it's the risk neutral probability. Why should I care? A very difficult question. The point is that now you do not need to go through this process. You don't need to solve this system of linear equation or anything. Because you know what's Q equal to. And to calculate the expected payoff of tomorrow, you only just to plug directly Q times CU plus 1 minus Q times CD times some discount factor. Where usually the discount factor is pretty much represents the risk of the market. How much risk averse are the investors, etc., etc. Some are really, I would say, attached to the market itself. As I said, the conclusion of all this is that anyone who will price an option now do not need to go through anything that I just described, but only need to plug CU and CD, multiply by Q and 1 minus Q, and then you have the price of your option. And we can take, I would say, an analogy that just the option price is just expected payoff under the risk neutral measure. But does every option expire tomorrow? Of course not. We have options that don't expire in a month or 2 months, or 5 days or 6 days. And from the beginning, I'm always talking about tomorrow, today, tomorrow, which is really not realistic. So what will happen if you have more than tomorrow? Let's say my experiment is in 2 days, 3 days, 4 days, 1 month, 2 months. We can easily generalize this concept into a probability of n steps, which means that today the price can either go up or down, with probability P 1 minus P, where again P just Q, different notation, and then again SU can either go up or down, and SD can either go up or down, and so on and so forth. And you can continue your tree until, for example, 5 days, 6 days, 7 days, and so on and so forth. So let's take an example. let's say that our option expires tomorrow. Let's say, so our option expires tomorrow, so we have a binomial tree of length 2. So the initial price is C0, and we know that tomorrow the price would be either C1U or C1D. So the first index means like how many steps. Then after tomorrow, okay, this should be CU2 anyway. So the cost would be CU squared or CUD, because UD means that it either went down and up or up then down. So that's why it's called UD. And then we have CD squared because it went down 2 times. If you're given this price, as we just said before, you could go back by 1 day and find this one, and you could go back by 1 day and find this one. Right? Just consider just the day before, because again, CUD is just the maximum of 0 or SUD minus K. And same thing for SD squared. To be just the maximum, do 0 and SD squared minus K. You're following? Good. So let's actually do it. Let's try to find the price of yesterday. Assume that each part minus R is our discount factor. Okay? Then we have that C1U would be equal to probability of going up, which is P, times Cu, plus probability of going down, 1 minus P, times CUD. Good? Then the probability that then C1D would be equal to the discount factor times the probability of going up times CUD, but the probability of going down times CD squared. Now you found the payoffs of tomorrow. Again, repeat the exact same step. Sorry? Wait. Yeah. So then repeat the exact same step to go back to C0. You have C1U, you have C1, and you have C1D. So C0 is equal to, again, the discount factor times the probability of going up times C1U plus 1 minus P times the probability of going, so the probability of going down times C1D. Then you plug what we found before for what's equal to C1U and what's C1D equal to, and you continue and you find the option price at time step 0. Makes sense? If you expand the tree infinity many times, I won't prove it, but we get the following closed form. We get that if n is the number of steps that we have in the future, we get that C0 is equal to e to the power minus n to the power of r, and the sum from 0 to n of n to j, p to the power of j, 1 is p to the power of n minus g, times the maximum of 0 s to j d n minus j minus k. There you go. And that's given direct formula, but that's exact same logic. Just go to the last day and go back 1 day by day by day by day until you get back to C0. Fine, right? That's binary tree. Okay? Now, how are we going to use this in quants? I'll let Adam explain you more.
Thank you, Ahmed. So, by a show of hands here, who has heard of a quant? Only Finn has heard of what a quant is. Okay. If you've ever watched The Big Short, there is this very good scene where essentially he enters the room and he asks him to explain the math behind what he's offering. And what he does is he just points and says, "That's my quant." If you've ever watched The Big Short, you'd understand the scene. If not, just trust me, it's a really good movie. You should watch it and look for this scene. It's very good. But yeah, quants are talked about. They're this almost, this magical universe where they make $500,000 plus on Wall Street, where they're the most in-demand workers in Wall Street, and they make magic. They print money out of nothing. Those are quants. But I'd like to actually make who quants are a bit more feasible for you guys to understand who they are, what they actually do, who they work for, so that it's not this la la land of people who make money out of nothing. So, quants work primarily for 3 different industries, or 3 different employers. First, they work for investment banks. Taha asked me before, who would actually sell me these instruments? Now, Deutsche Bank is an investment bank, and Deutsche Bank would hire quantitative traders, or would hire quants, to actually price what the fair price for this put option or call option is, and sell them back to you. And the people who would do that are quants. They would figure out the price for that. Second are for hedge funds and trading firms. For example, one of the most successful firms on Wall Street is Renaissance Technologies by Jim Dimon, if you've heard of him. And it's basically it's full of quants, and they're one of the most highest earning hedge funds in Wall Street. That's the second biggest employer of quants. And third are asset managers. So similar to hedge funds, but think of something like a pension fund. They would also employ quants. And despite that these industries actually sometimes compete for the same asset. So a hedge fund would compete against an investment bank when it comes to buying a call option, because a hedge fund would buy it from an investment bank. So an investment bank would want sometimes the price of an asset to go down so they can sell more put options and charge higher premiums. And the hedge fund would actually want the price of the asset to go up so they can post higher returns for their investors. And so quants actually play on different sides of the market, on different sides of the industry. Sometimes they compete against each other, so it's a quant versus quant world in Wall Street. But what do they actually do? We said who they work for. Who do they actually work for? What do they actually do? So, as I told you, they price financial instruments. Derivatives or collateralized debt obligations, or all these fancy terminologies for different financial instruments, they're all created and priced by quants. Second, they measure and manage risk. If you're a big hedge fund and you want to use mathematics to decrease your risk, decrease your exposure in the market, you'd hire quants to come up with mathematical formulas and different models to actually see how you can decrease your exposure. And three is they build trading strategies. Those trading strategies could be a computer program that executes automations automatically, for example. But we'll get to see more examples. Okay, so pricing. I already mentioned this, but basically, briefly, the quantitative trader builds a model for the investment bank, and based on the current market conditions, volatility, and the time remaining until the strike price expires. Actually, Ahmed was just telling me for a class last semester called Financial Modeling, I believe.
Financial Modeling is a classic model.
It's a class for math majors. I didn't take it because I'm not a math major. But you'd essentially be doing what a quant does. Based off of these conditions, based off of the market conditions, based off of volatility, you would model that and price these different assets. And that's what a quant does. Second, for risk management. Again, you're a hedge fund and you want to lower your risk, you'd use a quant. And they build very, very advanced models. You know? When we think of finance, we always think of Excel, because that's what most finance pros do. If in your mind finance pros are people who wear quarter zips and play beer pong, then quants are the people in the back of the room writing away at code at 12 a.m. in the morning, 12 a.m. at night. So 1 a.m. at night, just writing code, building different models to actually price these assets and lower the risk. And they avoid catastrophic income because when you have math behind the finance to actually explain what you're liable to, what your risk exposure is, then you can actually avoid catastrophic outcomes. And for trading and strategy, they analyze huge amounts of market data. They don't do it themselves. They build the programs to analyze that. And they detect different patterns, statistical patterns. For example, if they detect a statistical pattern where if event happens in country A leads to an arbitrage opportunity in country B, then they build a computer program that takes advantage of that and creates profit for the firms. And they exploit these small inefficiencies within milliseconds. I'll actually give a very good example right now. But before I do that, I'd like to explain that financial models, I mean, Ahmed went into a lot more math, but you know, in the most basic form, y equals mx plus b. It has an input, the slope-intercept form, it has an input, and with it you get an output. Models are similar to that. Based off of the market conditions, interest rates, discount rates, you plug in the different data you have available, and it outputs statistically significant figures that you can use to make different investment decisions. Okay, and now I'll actually use a good example. This was actually explained by a trader in Wall Street who works for the Royal Bank of Canada. And it's actually very, very impressive. So let's say we are the Royal Bank of Canada. But in this case, we're Constructor University Investment. Does everyone like that name? Okay, we're CUI. And we are this multi-billion-dollar firm, and we have amazing technology, right? But we want to buy 100 shares of, let's say, NVIDIA. We've invested in our infrastructure, we've invested in everything. And we have these crazy fiber optic networks so that we can execute a trade in a couple of milliseconds. So let's say we want to buy 100,000 shares of NVIDIA. So what we do is a trader is sitting here would put an order for 100,000 shares of NVIDIA, right? And what happens when you place such a large order is it goes through something called a smart order routing. It basically takes up all these trades, these 100,000, and it splits it up into different exchanges. So let's say it goes to exchange one, it can go to the NASDAQ or the New York Stock Exchange or whatever. It splits up these orders to avoid having such a large bulk order, and splits it up into different exchanges. So this can be exchange 1, exchange 2, exchange 3. To keep it simple, let's say exchange 1 is Bremen, exchange 2 is Frankfurt, and exchange 3 is New York. Now, simply because of geography, because Bremen is located closer to us than Frankfurt, and Frankfurt is located closer to New York, there's going to be a difference of a few milliseconds in between the first order arriving to Bremen and the second order arriving to Frankfurt. So we place this order, let's say 10,000 of these orders go to Bremen, and this takes, let's say, 300 milliseconds. Again, this is insane speed, right? What a quantitative trader would do is he would actually use a computer program, and what he would say is that there's this massive order coming to the exchange in Bremen. And he knows, he can predict, that because this order is being split up from the order of 100,000, that means that this order is also probably going to be placed in Frankfurt and in New York. So what the trader does, what the quant does, is he intercepts this order of 10,000 and says, okay, there's this massive order for 100,000 shares of NVIDIA. It means that there's this very big demand. What happens when there's a very large demand for a certain stock? Exactly, price goes up. So what a quant would do is intercept this order, and then before our original order reaches Frankfurt, let's say here it takes 300 milliseconds, it takes 600 milliseconds here, and 900 milliseconds here. The quant intercepts this order coming 300 here, and then places an order to the Frankfurt Stock Exchange and to the New York Stock Exchange. And because the quant is using these very, very advanced computer programs, he can place this order in, let's say, 200 milliseconds. And from here, it takes him 300 milliseconds to reach. So again, we're talking about the blink of an eye is 300 milliseconds. So a quant intercepts this order and then places himself orders in Frankfurt for NVIDIA stock and places orders in New York for also NVIDIA stock before our original order reaches those exchanges so that they can sell them at a higher price to Constructor University Investment. Because we placed the remaining 90,000 stocks are going to go to New York Stock Exchange and Frankfurt Stock Exchange. But because we already bought these stocks before they arrived from our original order, the price is ever so slightly going to increase. And so even if we only make a profit of a few dollars, for 90,000 different shares, it actually gives you a very, very large profit. And the only way this is feasible is if you have a computer program that can intercept, predict, and calculate and execute those orders within a few milliseconds. Do you guys understand how advanced and crazy this is? we're placing an order that is traveling almost at the speed of light, and a person who is physically located closer to Frankfurt in New York, a quantitative trader, can take advantage of that and exploit us and sell us the stock that we already bought at a higher price. Yes, Ali?
Question now.
Yes.
Okay. But constructing a risk investment, aren't they expecting to pay a certain amount when they place that order? How does the price increase and they have to buy it for a higher amount?
That's a very good question, actually. So what usually happens is, let's say the price of NVIDIA is, I mean, it's not, right now NVIDIA is very expensive, but let's say for small numbers, NVIDIA is $30, right? When you're trading in a hedge fund, you see the price of $30, and based off of that, you execute an order. So we're going to buy 100,000. We're expecting the price to be $30, and we execute the order 100,000, and this entire order is going to be executed in less than a second. So realistically, you know that you're probably going to get a price of around $30. But because we're buying this stock before the full order re-executes, the price is going to go up ever so slightly. So let's say $30.01. So instead of expecting to pay $3 million, sorry, you actually end up paying $3 million and what would that be? 10 cents times 100,000, that would be $10,000. So it's only a difference of around $10,000, but it's acceptable when you're trading.
Okay, so they account for some area, they allocate more money to it.
They account for some.
They can.
It's called a spread.
Okay.
They account for that, and that's acceptable. But you can imagine how if you have a computer program that takes advantage of this across millions of different trades in a day, you can make a lot of money. And that, I think, is one of the most interesting ways quants actually take advantage of this. And yeah, and the most important thing about a quant is he doesn't think in terms of a traditional trader. You know, he doesn't think, will the price go up or will the price go down? He thinks, what is the current state of the market today, and how do I take advantage? How do I exploit certain inefficiencies? And I would like to give the rest off.
Thank you, Adam. So, we talked a lot about financial finance, right? If we continue, I would like to ask 3 questions. First, who's bored here? Okay, perfect. Second, just for my knowledge, who knows what's a derivative? Raise his hand. Okay, who knows what's a partial derivative? Me? Okay, good. Okay, who knows what's a normal distribution? Okay, actually, very good. Okay, good. So I'm glad for that no one is bored, but in case there's someone who didn't want to say it, I will stop talking about finance for a while. And instead of it, I will talk about what? Water. So, what do we have in water? We have a particle. Now, a drop of water, a particle that's moving. For example, when you boil the water, right? When you boil the water, the particle can go left and go back. Up and go back, or even diagonally and go back. The point is that you cannot know. And in general, when you boil water, the particles don't go left, up, or diagonally. It's going pretty much, I would say, randomly, right? And you can't really predict it. And what's happening is what we call, not in finance, but in physics, a Brownian motion. So what's a Brownian motion? And who found what's a Brownian motion? Funny enough, not someone related to finance, not someone related to physics, not someone related to math, but a botanist. So, let's define rigorously what's a Brownian motion, and let's then go back to quantitative finance. So, as I said, Brownian motion was discovered by Robert Brown while looking at pollen on the water, hence the name. And as I said, Robert was the botanist. And what's really a Brownian motion precisely? Well, it is just a way to model our stocks, their evolution during time. Because from the beginning, when we talk about tomorrow, after tomorrow, after tomorrow, from now on, time will be continuous. And we will use Brownian motion to be able to model our stock. And instead of the molecule, we'll be talking about the stock's price. And the other water particles will be the random market forces that are pushing up or down our stock's price. And as a side note, we also call this a Wheeler process. But yeah. So let's define actually what's a Brownian motion. Do you want to wait? Okay, let's define what's a Brownian motion. So, a Brownian motion is a stochastic process, W of t, so t is the time, and W of t outputs what's the stock's price currently, if and only if. First of all, it starts at 0. So the W of 0 is equal to 0. Then each realization is continuous. So as we saw before, the price was going continuously. Then for any zeros more than A is more than B is more than C is more than D, the increment between D and C and B and A are completely independent. Meaning that for each fraction of time where stock is going up or down, it has nothing to do with whether stock went up or down before. And then for any T1, T2, W of T2 minus W of T1 is distributed according to the normal distribution with mean 0 and variance T2 minus T1. For those who don't know, the normal distribution is just a sort of distribution of probabilities where we say that the mean is called mu, and the standard deviation that represents how much do we usually deviate from the mean, from the expected value, basically. And we will use this to represent accordingly our stock's price. And to just understand a bit what does a really Brownian motion represent in the stock. So for example, imagine a forward realization. With, for example, one realization, the stock went down and then went a bit up, then on and so on and so forth until the end. And when in the other realization, started by going up, then down, up, down, and then went way higher than the other at time t. But the question is really this a good model to model our stock? Let's say that this is true, that's our stock price. It went under 0, went up, then again 0, and so on and so forth. Is that good? Is there something that is weird here? There is one. That usually a stock's price cannot be under 0 and cannot go negative. At least 99% of the case. And for financial modeling purposes, it does not make sense to model a financial stock using the Brownian motion mechanical because usually it goes negative in some probabilities. So that's why instead of which we use what we call geometric Brownian motion, defined as S of t is equal to x of 0, so at the beginning, times exponential of u, which is the mean, minus sigma square over 2, which is the variance. So how much do we deviate out of the mean, times t, the time, plus sigma times w of t, w being our old Brownian motion. Why is the formula exactly? I don't know. But we're going to use it later. So that's how we're going to model our stock's price now. You see, again, which we call a geometric Brownian motion. Then you can imagine that while modeling your stock price, you will multiple times, I would say, interested in some functions. You might be interested in knowing what's the square of your stock's price. You might be interested to know what's the square, what's the value of your stock price minus some threshold, so it's constant value d. Or I don't know, be interested to know what's the logarithm of s. And usually in maths or when we want to analyze a function, what do you use to see if the function go up or down? Say, Fanny, what do we use?
The derivative.
Exactly. We use a derivative to know whether the function is going up or down. But how does the derivative normally work? So as I said, the derivative, the point is that no one really knows where the derivative comes from. By definition, actually the derivative comes from what we call Taylor series. Who knows what Taylor series raise his hand? Okay, less than before, but yeah. So a Taylor series is just a way to expand our function. For those who don't know, it's not that, just forget about it. But just how the definition of derivative come from. And we say that fx plus some increment is equal to all of this expression. And then we check f to the left-hand side. and we get that it's equal to this all, which is equal to df, which is equal to all this expression. Yet, when you differentiate f, you do not care about this. Why? We always write df is equal to f prime x dx. We always forget about what's happening here. Because we take dx small enough so that dx to the power of any other I would be equal to 0. Now, let's use the same trick to compute the derivative of any function of our stock price. So, again, using the exact same trick, and then now using the chain rule, we would get that just input w instead of x here, you get f, it's equal dx equal to f prime w dw plus 1/2 second derivative the square, and so on and so forth. And what we set it for is that we eliminate dx because dx is equal to is small enough so that dx square and dx cube and so on is equal to 0. The question we have to ask ourselves now: can we throw away dw square? Who thinks that we can throw away? Raise his hand. Who think that we cannot throw dw? Raise his hand. Guys, what do the other people think? Who think that w will disappear? Raise his hand. Come on. Who think that dw won't disappear? Raise his hand. Okay. dw will, of course, not disappear. Why, you may ask? Let's go back to how we define w. So we said that for any increment wt2 minus wt1 is distributed according to the normal distribution of 0, t2 minus t1. This works for any t2, t1. So let's just like t1 with 0 and t2 with t. So we get that since w0 is equal to 0, we get in general wt is distributed according to some variance t, which mean, sorry, this is the standard deviation, and which means that w has a variance of square root of t. Okay, this is standard deviation, and the variance is the square root of standard deviation. Good. Then the point is, since we know that w has a variance of square root of t, then the expected value of dw square is dt. dt is small enough to neglect if its power is more than 2. But since dw square is equal to dt, we cannot just forget about dw. And that's why we have to keep dw in our calculations. And that's what we call in finance, and in mathematical finance, Ito's lemma. Ito is a very famous guy that said that, well, if we have f of wt for any function in that in this form, df is not equal to f prime w plus dw, but plus 1/2 of f prime w dt, or so dt dw square. And now, when you have that df is equal to f prime of dx, you could integrate easily and get that it's back df. But since you have that df is equal to this, try to integrate now. How will you do it? How will you integrate what's dw? Because remember, dw is random. Now, what's the integration? Like by definition, I think we also that the integral that we use, and maybe not everyone knows it, but actually the integral that we use and that we commonly use in general is what we call Riemann integral. No one thinks about it, and no one really thinks about what's the integral that we use, but since here we cannot use it, we have to come up with a different definition of our integral. Usually, Riemann defined an integral from a to b of f of x dx as the limit of some small intervals times f of x. And I think we also this picture of, we also this picture of some like smaller rectangles that we sum up and we get all of it, the surface that is under the curve. And that's what we used to call the integral. The point is that our intervals are fixed. Delta of x to y is determined and controlled, while dw is random by definition. So by definition we cannot use Riemann's integral. because it just doesn't make sense. And that's why we have to enter in a very, very interesting world. Different from the calculus that we also before, what we call stochastic calculus. In stochastic calculus, everything changes. Derivatives are not derivatives, integral are not integrals. Everything has a new definition. And starting by the integral, we invent, or reinvented at least, what we call Ito's integral. The difference between Riemann's integral and Ito's integral is that we do not have a fixed size interval. We have a difference of two different random functions which are getting thrown in motion. Ito's integral has very interesting properties. We all know about, for example, linearity that we used to have with our classical integral. And it still stands in Ito's integral. Yet, Ali, what's the integral of x dx?
Integral half x squared.
Exactly. Surprisingly enough, it is not the case in Ito's integral. In Ito's integral, the integral of wt dw is equal to w squared times 1 half, as I said, minus t half. Well, as we said before, in classical calculus, the integral was wt squared over 2. This example is to show you how stochastic calculus is fundamentally different from classical calculus. So, now let's go back to our previous question. We have an option that has multiple days, but now we don't have this, we have a continuous time. And we want to find the price C as a function of the stock price S and time. And we want to find what C must satisfy. So now C will be strict value. C will be depending on the stock function itself and what is the time currently. And now, this will get very messy. So, let's continue. So, we will now together try to find what does our function C must satisfy. And we will get something very interesting at the end. In general, what is something that describes how does function work? When in engineering, when you want to describe how does the function move, what do we use?
How does the function move?
Yeah.
Derivative?
No. Something that the function satisfies.
Equation?
Close. Equation of a function? What's the equation of a function?
The equation of a function.
A function has a solution, an equation has a solution, a function. An equation that has as a solution, a function. I know you all know which one. A differential equation. An equation, when an equation has a solution functions and strict values, we call that differential equations. And now I think you all remember it now. So what we will try is to find a differential equation that our stock price must satisfy, and together we'll find it now. It will be messy. How of you want to understand? I don't understand completely, but I will do. So, first of all, we'll start with applying Ito's lemma to C. So Ito's lemma said that d of C is equal to partial derivative of C with respect to T times dt plus partial derivative of C with respect to S times ds plus 1/2 partial derivative of second partial derivative of C with respect to S. Then we apply Ito's lemma to S. We get that ds is equal to mu S dt plus sigma S dw. And square this, and you get sigma square S square dt. Because dt square is negligible. Then substitute ds and ds square back into this equation, and you get this very beautiful line. Fourth, consider a hedging portfolio. Fifth, differentiate. Sixth, use no arbitrary assumption, and then by no arbitrary assumption, the risk-free portfolio must earn exactly at rate R, otherwise there's an arbitrage. 7, use the arbitrage, And 7, finally, rearrange, and we get what we call, as Adham mentioned in the very, very early beginning, Black-Scholes partial differential equation. I know that half of you didn't answer the proof, and even I don't understand it completely. But the point is that that is the equation that people use to understand the behavior of a function. And finding the solution to this equation gives the exact behavior of the price. But we talk about quantitative finance. And do you think that quantitatively you do this? Of course not. Usually, they use, for example, these values, delta and gamma, which are called, for example, delta shows how much the option moved with the stock, and delta shows how much the delta itself changes. And if the equation is not solvable, usually quantitative is what we call a Monte Carlo, or find such methods to extract the exact option price. In the very beginning, we had very discrete stuff. We had these very fine values and matrices. Black-Scholes equation is just the exact same concept took to the extreme. We have continuous time. We have continuous states. And instead of a matrix, we got a partial differential equation. And yeah, to conclude, finance is not easy, neither hard. Yet you do not need to be a mathematician to know about it. I myself a CS major. And you don't need to be an IB to know to use finance. And that is the IM. I think that's a very interesting topic. And that you really should be all interested in. Because we don't want to earn money, right? Thank you very much. Sure. Any question? No. Okay, then thank you very much for coming, guys. This was the best collaboration with such in IB&CM strategy. I look forward to more. Of course, you go free home. And have a good evening, guys. Thank you very much. That was very good.
Really well.
Okay, the basic one. Can you repeat the very easy question, please. Now let's
This one is actual finance, personal. Do you scan the application? Doesn't You will say yes because Ahmed was giving home. Should we do more collaborations with the IB&CM system? IB&CM? We're both IB&CM and Mastercard. Yeah, and I am. Yeah, I'm head of HR for Yeah. Okay, but that's math. That's math. That's also math. That's also math. That's why you have to do it. Otherwise, he started. That's not next year? Okay, that's fair. My hair doesn't look like this.
What will be the questions?
Do you want full body? Do you want
From the knee.
from the back? But we want like the things look here. It's too far away. Tell me when you're ready. And please record audio. Can you get a little bit closer to each other? You can talk with Papa and if subtitles. Wait! Adore, you didn't tell her that you were. Okay, you can do it now.
we came here with construction universities. What do you think in general no, from what's the I think that's every student. I took a photo card. It was not here from the university. The whole environment is to focus each of you to
It's obvious that you're genius.
The application one.
No, so this question.
There are a lot of varieties.
The university is not.
If the university has a there are no tax for the last 2 days.
Can we take a picture with you? Take a picture with you.
Yes.
Always.
I'm hiking with that.
Oh, really? You want to have a shot? I
don't know. Jeb,
I can't take a picture for you guys.
Can we make a selfie?
I don't know.
Okay. I don't know.
Me too.
I just heard your name.
Oh.
Make it a selfie.
That's engineering. That's engineering.
I will take the photo.
I have it.
Okay, can you all move closer? Can you all just move?
Yeah.
Okay, yeah, this is fine, just a minute.
You're sure about
I'm
that?
just trying to set the timer.
I'm taking yours. Okay.
No, 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 29.
1, 2, 3. Smile. Okay. Another one. Smile. 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 Your mom. Oh, that wasn't the last one.
Okay. Let's see.
It's fine. Okay, that's great.
Thank you. Have a nice day.
Thank you very much for the.
You're welcome. You're very welcome.
You saved us. I don't know why it's the problem. Let's try it.
I mean, this room is just.
Au revoir. C'était un plaisir pour moi.
Where's the victim? لا 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 فلوس guys oh yeah thank you very much
Yes. Mother himself, the black shoes is way cheaper.
I remember
You remember?
First the price of the equation was really 4 5
Different.
What about the ones which are open?
What, sorry?
What about the ones which are open? The open snacks.
How many are open? Two chips, two what?
2 chips.
Two chips, how open, like how used are they?
Like one of them is almost about to finish, one of them is almost full.
Okay, check both. One for you, one for him, divide however you want. One, two, three.
Come on.
With the Gaussian distribution comes.
Bro, I just suggested that it was never.
The